Hello, Jim here. Today I want to talk about one of my best weeks I've had a couple weeks ago where I earned nearly 2,500 in premiums in 1 week. I'm going to talk about some strategy changes I made. To me, it's more small changes, not huge changes that take you in a completely different direction. Over time, just small changes can have a big impact. So I'm going to talk about those. I'm also going to talk about the 10 trades. I'm going to share with you those trades at the very end of the video, so be sure to stay until the end. Okay, a quick market update. It's been a rough couple of days. The week started out up, but yesterday was a rough day. The Nasdaq was way down. I think the S&P 500 was also down a bit. We started up today, and now it looks like we've given up the gains, and now we're in kind of negative territory again. Are we in the midst of a major correction? I don't think so. I do think we are there is a little bit of a flight to quality, and I believe the fact that the Russell 2000 has been going up so much, it's kind of some of the other companies that were left behind are now, popping a bit. So will this continue? I think so. I don't think we've hit a major correction yet, mainly because with the Fed, they've pretty much guaranteed a rate cut in September. So I do think we're going to get that rate cut. I do think it'll probably be a quarter point. They might surprise us with a half a point. And I think that'll probably send the market higher. So I think this is kind of a temporary dip. Are we going to have a major correction? I don't know. I do want people to stay safe, to not do crazy trades. Don't take a huge amount of risk. I'm taking less risk, at least until we get through the politics that are coming up over the next couple of months. We just don't know what's going to happen next. So short term, I see a little bit of a dip, then a higher climb, and then we may get a correction. If I was a betting man, I would think the correction may be late in the year, early next year. So, and that's my 2 cents, and it may only be worth 2 cents. So I always talk about in my videos how one of the most important things, or not one of them, the most important thing is finding great companies. Picking companies that have good profitability, low debt, have year-over-year earnings growth, and just they're well managed. To me, it's extra icing on the cake if they pay dividends and are growing those dividends. So it's less about are they paying dividends, it's can they afford the dividends and are they growing dividends? And by identifying companies that are good quality companies that have those criteria, and then by selling puts on them, you're getting a good price on that particular stock. I feel like a lot of people, when they trade options, they're looking at the market so much and looking at the stock price that sometimes they forget why did they make the trade originally. And I think going back and remembering, I wanted to own that stock. I wanted to own it at that price. So assignment is worth it because, again, my goal is to own that stock. Now, if your goal is not to own that stock, then, maybe you're just doing the wheel. So it's a little bit less important, but I still suggest that picking good companies, even in that case, because you might change your mind and decide you want to keep the company. Plus, a healthy company will probably be trending up, and it'll be a little bit safer to trade. If you're picking companies that have huge amounts of debt and, not good profitability, they could hit negative territory. They could bounce all over the place, and they could literally go out of business. So I'd like to start out with talking about that in most of my videos because I do find it's really, really important. So in the trades that I made a couple weeks ago, I did change some guidelines. I am primarily doing vertical put credit spreads. A lot of people feel like spreads are a little bit more risky. I think they are not. I prefer to have the protection of purchasing the put, and I'm primarily looking at using a delta of 15 for the short put, meaning I want to buy the stock at that particular strike price. So, and that's right around a 15 delta. Now, as most of you know, it's really hard to hit on an exact 15 delta. So It may be a 19 delta because a 15 delta doesn't exist, or it might be a 13 delta. In some cases, I might do a 22 delta. If a company missed earnings and they drop, or missed guidance, then they might be at a better price. So I might take a little bit more risk, but not a huge amount of risk. And the other very important piece of this is setting up these guidelines. I like to trade typically between 30 and 90 days, averaging somewhere in the middle, like 45 days. I also like to pick like 15 deltas for the puts and 20 deltas for the calls. And I also have other criteria I like to look at. Again, we already talked about quality companies, but then I also, like to work with the same companies that I've got a good feel for. I know how what happens with them in the market, and then being consistent. Learning what goes wrong if something goes wrong, and then adjusting it. Like originally, I had 20 deltas for puts, and I lowered that when we went through 22. Now, recently, one of the big changes I made was, again, shortening that DTE, or the expiration, not going out quite as far, especially with puts. And one of the things that helped me with doing that is trying to avoid earnings. So most of the trades I've made in the last month, I've avoided earnings, and it seems to work really well. Now, you may ask, well, what do you mean by avoiding earnings? I typically will wait till earnings come out. If the stock gets hit hard, then I will, and I still like the company, then I will look at making a trade on it, and typically I can get it at a lower price. If the company goes the other way, well, then I might need to wait a little bit longer. But just avoiding the earnings, because I've made trades where they expired right before earnings, and then bad earnings came out, and then I got myself into trouble. So avoiding the earnings has helped quite a bit, and I've been more successful. It's forced me to go shorter term, maybe potentially take less premium, which in the end means higher return on investment. So, and that was suggested by subscribers and members, and I typically didn't worry about it up until, again, the last couple of months, probably the last 90 days or 60 days, something along those lines. And then with managing trades, understanding when you're really in trouble, because a lot of times, stocks aren't in an exact trajectory. They will go up big, come down big, go up big, come down big. So there's times with pretty much every position that I own where it'll go in the money. So the important point is identifying how deep in the money it can go, say, for puts. And the same thing with calls. Now, for puts, I found if it goes deeper than 10% in the money, there's a high likelihood of assignment. And the closer you are to expiration, that chance of it being assigned early goes up and up and up. So I typically don't worry about positions that will fall into the money below that 10%. It also works pretty well with the spread. If it goes through both sides, the strike or the put you sell and the put you purchase, and goes below the purchase put, it's usually going to have an early assignment, and that's what I found. Now, calls are a different beast. The 10% rule that I have set up doesn't really work as well with them. I've had stocks that have been in the money for many, many years. Con Edison is one example, and I keep rolling it at 85 and bringing in more cash, and I've been doing that for years. I also have others that are $15 or $20 in the money. What's important with calls is, always selling calls above your cost basis, and primarily only doing covered calls. I'll do a call credit spread, but only do it with an iron condor. So being able to manage these trades, identifying, can I roll it? Do I need to roll it? And then also I will go through a lot of my trades, especially the ones expiring sooner, and use what I call my planning worksheet and identify any I can close early. And a lot of times I'll do it literally every position. If I can just glance at it and see that it's fairly inexpensive to close it, then I'll go ahead and close it for a fairly good profit. I hold on to too many, probably too long. And that's one thing I'm working on. I'm planning to close more. I'd still have some expire, but I'm definitely moving along the lines of trying to close more than let them expire. And what's really helped me with that is the planning worksheet that I have developed. Originally, it was just literally trades that were expiring over the next 2 weeks. Now I have all my positions, but they're sorted by what will be expiring. And it allows me to see everything in one spot and keep track of it. I usually have, I think right now I have close to 95 positions that are open at any one time. And I share this planning works with my membership, and I'm just going to touch on my membership really quick. I have what's called the Investor Club. I share all my trades. So when I make a trade, I will post it to Patreon and they'll get a notification of it right away. I will typically put in a pretty long description describing why I made the trade, how they might want to do the trade differently depending on their situation or their portfolio, depending on if it's different. I also will suggest if it's a covered call, if they want to get into the stock, what would be a good price. So I share a lot of that, and I share that with all levels. So everyone above the investor club level also gets that. They also get all my planning worksheets, all the different spreadsheets that I share in these videos. So it works out really well, and you can get a week for free, and it's fairly inexpensive at $10 a month. Then I have what's called the Traders Club, and it includes, again, everything with the Investor Club, but you get access to Discord, and the Discord's gotten very active. There's a lot of traders sharing their trades. There's people doing futures. There's people doing zero DTEs. There's learning. There's also people talking about, setting up a business, trading as a business, what kind of entity you would want to set up. And then I also, every other week, I have what's called my Traders Club meeting. I'm getting ready to have one this Sunday at 8 p.m. where we talk about different things. Last week, we talked about ChatGPT. The week before, we talked about zero DTE. And that membership, there's no free version. It is $19 a month, but you get a lot for that. And then finally, I have what's called my coaching club. That's soon to be $45 a month, and you get 2 sessions with me each month. I describe them as 15-minute sessions. They typically always last to 30 minutes, but you get to meet with me. You can share, your trades with me. I can share my trades. We can talk about goals. We can talk about planning. Pretty much whatever's on the member's mind, we can talk about. So just wanted to share that. And again, please subscribe, hit that like button. If I wanted to create something that people could afford, so it was affordable, and then, something that would help people kind of take the initial steps. So I just kind of wanted to share that, mainly because it's worked out pretty well for new members. It allows you to kind of get a jump start and avoid making mistakes. So, and then it's not a big cost burden. You can get in. It's monthly. Currently, I may offer a yearly not free membership, a discounted membership. I'm also looking at that. So enough about that. Let's jump into the next part of the video where I'll talk about the 10 trades that I had I believe 3 or 4 weeks ago. So let's jump into the next section. Okay, now I believe in the previous part of the video, I've mentioned that it was June trades. Actually, these are trades from last week. So it was literally the second week of July, and I had 10 trades, and I'm just going to kind of jump through them. I've color coded them. So the first one is NVIDIA. This is a covered call. It was a roll. I rolled it from 142 expiring on 8/16. Originally, it was a 21 delta. At the time, it was 129 when I opened it, and I rolled it to 920. Increased the strike to 143, so only by $1, but I brought in 398 in premium. The capital required was 652, which is really, really low. You might ask, well, how's that so low? Well, these are shares I bought back many years ago, so my cost basis is literally 652 for the 100 shares, and the yearly return was 301. So being able to sell covered calls on NVIDIA is really nice. Now with NVIDIA having come down quite a bit, these are, I believe, very profitable. I may be able to close them early. The next is Square. Square went through a rough period, I think about a year ago, and it's been doing fairly well lately. I think it's come down a little bit, but another roll. This was I did this trade on 7/8, which is about a week ago, a little more than a week ago. Originally, I set this up on February 16th. It was a cash secured put at $65, 2 contracts. At the time, it was 64.49, so right at the money. And I rolled it to 8/16/24. I lowered the strike, and I brought in an additional $376. Now, since I set this trade up, I've made over my total premium from, I think, the initial trade, and I think this is the second roll. I originally set this up, like I said, in February 16th. I brought in literally $1,161. Required capital, cash secured put, it is a lot higher, and it's still like a 31% return, which is really good for a cash secured put. Yeah, I did 2 rolls in 1 week, so that's also why it's so high. The 376 includes the 2 rolls. I had forgotten I had already rolled it, and I was able to roll it again and pick up even more premium. So next is XLE. I have been trading in XLE more so than the other energy companies. This is the energy ETF. It has most of the big names like Exxon and ConocoPhillips and a lot of the big energy companies. This one I did on 7/9. This is a new vertical put credit spread. The green designates that it's a new trade. So it's still open. It's not closed. It's a vertical put credit spread, 85.75, a 23 delta. I will go a little bit higher with deltas for ETFs. I find that ETFs are a little bit safer, and I can take a little bit more risk. So I will go and do a low 20 delta for ETFs for puts. For company ETFs, I typically, or company puts or puts on companies, I typically will stick to around a 15 delta. It was 89.24 at the time, and I brought in $283. Was that on 3? Yeah, actually it was on 3 contracts. So that's the first time I did 3 contracts. I'm going to start doing 3 contracts on what I think are really good ETF plays. So, and it was like a 52% return. And this is 3,000 minus the 283 is, what capital I have at risk or the max loss. And it's, if I close it or it expires, or if it expires, it'll be like a 52% return. Next is Google. I had done this originally as the shielded wheel. It was a new type of trade that I did where I bought 100 shares, I sold a covered call, and then I also sold 1 vertical put credit spread, and it's worked out pretty well. I rolled this. This was the covered call side of the wheel, and it was 185. It was expiring on 9/20. I rolled it out to 117.25 and then increased the strike price to 195. And I brought $210. Now I could have gone lower. I could have done like 190, and I think it would have been twice the premium. And now looking back, I believe Google is like 178, 179 with the drop the last day or two. But so the required capital, I'm using the basis. So I ended up picking up the shares when you look at the covered call premium and the vertical put credit spread premium, which is now I've closed. This is a much lower return because I did roll it out to 117.25. It's like 2.5%, but again, I believe I picked those shares up right at $160. So, and I've only had them since 5/31, so a pretty good return. And this is I've only done this one shielded wheel trade. I'm probably going to do more. I did a video on it a while back, so take a look. I think it was maybe a month back that I did that trade. And then Target, I did recently. Target has come down quite a bit. So I did this trade July 10th. I did 2 contracts on the Google. I only did one, and I also only did one on NVIDIA. I did a vertical put credit spread, 135, 125. It was 143 at the time. It was a 0.19 delta, which was right around, I think the next delta might have been like a 0.14. So I could have gone much lower, but the premium was much worse below. So 0.19, I did take a little bit more risk with this. So I brought in 195 in premium. The capital requirements were 1804 against, again, the spread minus the 195.30 is how I came up with the 1804. And it was like 107% return, which is just this divided by this, adjusted for the year. Wrong one, which was only 37 days. So this was an August 16th, expiring on August 16th. So, and that's worked out. That's the first trade I've ever done on Target. And again, all of these, there's no two are the same. They're all different companies or ETFs. Next is IJH. This was a covered call. And it was one covered call for IJH at 61. At the time, it was 58.41. I believe it's still right around 61. A 21 delta, again, sticking to that near 20 delta for calls. And brought in 129, a little less money, but again, it's one contract. Those shares actually, I think they had a 5-for-1 split. And so I think it put me at like 90 some shares, and I bought enough to have 100 so I could sell the covered call. The capital required was $37.50. So that's my original cost of those shares. I paid, I've had a pretty good return on them. I paid, if you divide that by 100, $37.50 per share. And this is like a 10% return, which is really good for a covered call. It's much more than doubling the dividend. Next is IWM, again, another ETF. This is the Russell 2000. This I actually closed. It was vertical put credit spread. And when recently I was able to close that pretty cheap. Let's see what I paid. I paid $8.30, so it was very, very profitable. And I closed it early. The date was 7/19. This was 7/11. So it was actually higher than the original return I was showing for it. I think I was showing like a 54, and the return ended up being 58. Next is Delta. And again, another stock I've never traded before. My emphasis was more on avoiding earnings. So they had just had earnings. So I decided to make a trade on Delta. This is a scenario where I made the trade after earnings. They made earnings, but they missed revenue. And then I think guidance was not as good as the market was hoping. So they dropped quite a bit. So if I had made this trade before earnings, I probably would have made the trade, $5 or $6 higher, and could potentially have been in the money at this point, but it's still fairly, I believe they're right around 50 now or 48. This was in my Fidelity IRA. You can see which accounts these are in. Vertical put credit spread, 41.31. I like the $10 spreads, a 25 delta. So I did take a little bit more risk with this one. Again, we could say it just had earnings and got hit pretty hard. If they, this is where I was talking about earlier. I'll take a little bit more risk if I feel like the stock is at a really good price. Plus, I believe if you drop down to 40, the premium dropped majorly. And to me, earning a lot less for $1 less doesn't make a lot of sense. So sometimes you have to put basic logic in there. Does it make sense? Should you half your premium to go down $1 more? And in this case, it didn't make sense. So 9/20/24. So I had to go a little farther out. It was 44.08. And I brought in some pretty good premium, 269.97. Again, 2 contracts, or was that 3 also? Yeah, 3 contracts. So again, I'm beginning to move from 2 to 3 contracts. For the longest time, I was at 1 contract per trade, and then I went to 2, and now in some cases I'm going to 3. I'm also basing it on how expensive the stock is. So with Delta being, the strike price being, what was it, 40? Where's Delta? 41. To me, it felt okay to do 3 contracts. And this is like a 51% return. And Delta has good numbers. I mean, they have good profitability. There's a lot to like, even though they're an airline company. There's a lot of people that say don't invest in airline companies. Same thing with car companies. A lot of people say don't invest in car companies. Cisco's been kind of going through a rough spot. So this was another roll. I rolled a covered call. And I believe I rolled this one down. So this is one of those. No, I kept it at the same price. Sometimes I will roll it down. I do think that Cisco, it's going to get a pop at some point, meaning they're going to come out with some good earnings or something about AI, and they'll be back in the mid 50s again. So I rolled it to 620.24 from 117.20. This should be 620.25. That's a typo. And brought in quite a bit of premium, $398.68. And this was, again, with it being nearly a leap, the 343 days. So it's this divided by this, adjusted for the year, which again is almost a leap. It's 343 days out. That's why it's such a low return. This I did not beat. I did not double the dividend. I came fairly close. I think their dividend is right around 3.2. And see, the last one is Coca-Cola. And I do a lot of the Coca-Cola trades. That's how I got started. I started selling covered calls many years ago, probably 13, 14 years ago. And I made a nice steady income just selling covered calls on Coca-Cola through the years. This one I did on 7/12. This is in my broker account. So was the Cisco. There's quite a bit in my broker account this time. I am trying to generate a lot of cash for a land purchase. So that's part of the reason why I'm rolling some of these. I do want to generate a bunch of cash in order to pay for the land that I'm buying. This was a 22 Delta. It was expiring on 6/20/25, and I rolled it. Actually, this was a new trade. With it being green, it was a new trade. So expiring 6/20/25, 72.50. Coke at the time was 63.60, and I brought in 208.66. The cost basis is $5,000. This is actually probably high. That's like $25 a share. But I've owned these shares since I was a teenager. So my cost basis is crazy low. And I don't ever want them to be called away. So I roll them up and down as the market moves, and it works out really well. And this is like a 4.4% return. It would be 1.7% with the current, meaning if I set it up as 13,000 or 12,000, meaning the current value of Coca-Cola, it would be like a 1.7% return. Based on the 5,000, it's like a 4.4% return, but it allows you to generate quite a bit of income. And, for those of you who have a lot of shares, either through inheritance or, stock options, it's a great thing to be able to do. And with a company like Coca-Cola, it doesn't move much. So as the market goes up, you can roll it up. As the market goes down, you can roll it down. You can roll it. I've rolled in every direction. I rolled it out farther. I've closed them or brought them closer in expiration. It's worked out quite well. And I have different expirations. I try not to have too many contracts with Coca-Cola expiring on the same month. I go all the way out. I probably have 2 to 4 contracts for every expiration, and typically I try to keep above the price. I think I only have one that's even near 63.60. So works out well, and a great way to generate some extra income. So for the week, I had 24.63, which again is probably my highest week. And what's nice is my goal is 7,000 for the month and 17.50 weekly. So this allows me to, kind of pull back. if I find a trade or two, like I typically try to do at least one trade a day. I'm probably averaging closer to two, but once I find a company or I find a good trade, then I'm typically done. Like today, I think I'm only going to do one trade. Yesterday, I think I did two, maybe three. But I don't try to push it too hard. And if I can't find trades, then I'll wait for another day. So one thing I did want to show you guys is I found with Seeking Alpha, and this has become very helpful, is this earnings calendar, and it makes it really nice. So I've also been using this. So I will, like today, I could see who has earnings, like Netflix. I can see if it's pre or post market. I can see if it's what their year over year growth looks like. And I've used this a lot to identify who I want to trade. So I can also look at next week. What does next week look like? So we've got Tesla earnings, we have Google earnings, Coca-Cola, Visa. It just makes it really easy. So this way I know, well, all these companies are having earnings, and I can avoid them by making a trade after they have earnings. So if Alphabet has a bad earnings day and they drop significantly, then I could look on Tuesday to potentially make a trade. I believe Tuesday or Wednesday, and they go into quite a bit of detail. So here is Next Era Energy, another one. You got ServiceNow, IBM. So it just one feature that Seeking Alpha has that has become very helpful. I end up using this every day. So that's what I wanted to share with you guys. If you have any comments, please leave a comment. I try to answer them all, usually within 24 to 48 hours. So I encourage you, leave a message. Do you agree with me? Do you agree with the way I'm trading? Is there something I'm overlooking or missing? So any questions you might have, please leave a comment. So thanks for joining me today, and I look forward to seeing you next time.